good afternoon, everyone. Good evening, everyone. I think that's all the attendees in, and welcome. So I hope you're all sitting comfortably. Welcome to our new format of our Portfolios in Focus seminar. This is a rather snappier seminar that we pulled together with members of the investment team. I'm joined this evening by Julian, James, and Will. Mr. Edwards, Mr. Keith Edwards, has to send his apologies. He is currently somewhere between London and Salisbury on a train, so apologies there. He might join us, but I don't know if that's likely some point through the conversation. So my job on these is really to host it and to introduce my investment team colleagues. We're going to be about 30 minutes. We've got extra time at the end for Q&A. So please do, if you've not used Zoom before, there's a little button down the bottom, press Q&A, and that fires a question straight through to me. So if you see me burrowing away, apologies for that. I'm not checking my Instagram or anything. I'm looking at and monitoring the questions and the attendees. But first of all, before we get started, I just want to sort of introduce what we're going to be doing. We're going to spend a little bit of time. Julian's going to take some time looking at our current thinking and the wider economic picture. Will is going to have a little bit of a look of our portfolio activity, so a little bit more of a deep dive into what the guys have been doing on your portfolios. And then James is going to round the session up, all within half an hour, famously said, all within half an hour, and look at some of the outlook and the opportunities and indeed the risks that are coming up over the coming year. But I thought, just to get things started, I thought I would start by trying to use a poll. So I've got two questions for you, just for the panelists to gauge a little bit of the temperature of the room and see what your opinion is. So the first question I'm going to ask is, from an investment point of view, hopefully you can see that on the screen. I think the panelists can see that as well. From an investment point of view, what are you most worried about over the coming 12 months? So I'll give you a little bit of time there. Panelists, can you give us a nod if you can see that as well? Yeah, perfect. We've got a couple there worried about the ashes. I'll put that in as a little bit of an icebreaker, but you can see there, inflation and interest rates remaining higher. Give it a couple more seconds because I think we're mostly done there. Yeah, we're all done. So you can see results here. You can see that actually level pegging, inflation, interest rates remaining higher for longer, and indeed the current geopolitical tensions are top of your concerns. Now, bear me 2 seconds. Panelists, did you see those results? Perfect, thank you. Right, so as I said, the next question is on me. It's all right. I told you I'd get it. Launch. Back. One question. Unfortunately, I don't know about my first malfunction. It's saying that I've already shared it. A poll has been shared this week. Secondly, my second question was basically along the same lines, but what are you most optimistic about? And the similar sort of questions. A sustainable recovery. And apologies, I don't know why it's not letting me share this. A sustainable recovery. Well, panelists, can you see that, or is it? No. Okay. Sustainable recovery in global equity markets, energy prices returning to a degree of normality, diplomatic resolution to the geopolitical risks that we see, or indeed us winning the ashes. I think the answer would probably be the same. If we're optimistic, it would probably tie into what we're most worried about as well. So those are our biggest concerns. Apologies why it's not letting me share that. I will do some homework on that. So panelists, that gives us a little bit of an indication about what our guests are most worried about at the moment. And hopefully, if I get it working, we'll share that at some point during the session. But without any further ado, Julian, I'm going to hand over to you if that's okay. I'm going to be driving the slides, everyone, so you might hear every now and again Julian just asking me to whiz through the slides or move on to the next slide. So without any further ado, Jules, over to you, sir.
Great, thank you very much, and good evening, everyone. It's been, we can just have the first slide, please, Matt. Thank you. It's been, I think it's about a year since we did this last, and the first slide. I've been using this, each time we've done these sessions, just to sort of give a flavour of where we currently are, and how we're sort of seeing things over the sort of shorter term and over the sort of the medium term. And I think today, if you look back over the last 9-12 months, there's been a lot of talk about we're going into recession, The Bank of England saying that this could be, a severe recession because of inflation rising, interest rates, were therefore going to be rising quite aggressively. And yet here we are, 6, 9, 12 months on, and people are saying, well, where's the recession? And then we had some talk about a soft landing or no landing. So I think overall we can say that actually, yes, we've got some, some headwinds and some sort of tailwinds, but overall, the state of the economy is just relatively, relatively calm, I think we could say. The energy crisis, which we've heard a lot about over the last 6 to 9 months, has largely passed, for now. Inflation has peaked and is coming down, much faster in the US than it is in the UK. So I think overall, I'd say that things are reasonably steady. Then when we start sort of looking forward, so when we talk about sort of shorter term, that may be over the sort of next 3 to 12 months. I think something which struck me first of all when I was putting this together is that compared with about a year ago, when we were, had some reasonable concerns about the, what I'm calling the sort of negative scenario, and I've marked that down quite sharply. Because 12 months ago, we had just this sort of takeoff of inflation, and there's a lot of uncertainty about, okay, what are central banks going to do? How aggressive they're going to be? We also had just, the conflict in Ukraine had just started. So I think we had to be very aware of that negative scenario could, unravel quite aggressively. But I think that, the good news today is, we're marking that down, quite sharply, and marking up. What would I sort of call about sort of muddle through, is that sort of things are sort of generally okay. There are some headwinds, but we've got some tailwinds, and sort of by and large, I think we can be, sort of more optimistic than we were previously. Looking a little bit further ahead, sort of over sort of medium, longer term, that's maybe 1 to 5 years. Again, we're sort of marking up the more optimistic side. And I think it's important, and I'm not going to spend too much time, this is where Will and James go into a lot more detail, but, businesses, and particularly through things like, technology, we're continue to see a lot of evolution of the way businesses operate. Yes, there will be companies and sectors which will be struggling because of higher inflation, higher interest rates, but also companies which are continuing to make, good headway. And obviously those are sort of the sectors and the companies which we try to focus on in portfolios. I think just down towards sort of the bottom right, the negative scenario I'm marking down a little bit, but the black swan, what we call the black swan, I'm just marking up just a touch there. And I think there's sort of 3 areas which we just need to be mindful of. Again, this is still the very, the smallest part of our thinking, but we do need to be aware of, what could go wrong, what could shock portfolios, because this can often be the shock which concerns clients the most. So it's just to sort of say that we are looking at these areas which could, sort of out of the blue. And then if you just had a bit of a think about them in advance, when it happens, then you think, okay, yeah, we had thought that might happen. And we've perhaps stress tested the portfolio just to make sure that, we're not going to be too negatively impacted. And that's around things like central bank policy error, how do they bring down inflation, but without tipping economies into recession, geopolitics, and rising populism. So if we move on to the next slide, and I thought the main sort of topic I was really going to talk about was inflation and interest rates, because that's it's the topic on the news a lot, and it's probably the thing which concerns clients the most. On the left-hand side, really, I'm just looking at market expectations for interest rates over the next 5 years. And obviously inflation, as we're seeing it has peaked, it is coming down, and it could fall fairly quickly over the coming months. We're seeing that much more in the US than in the UK. But if we just take the US, for example, because this is obviously the biggest economy in the world, so that's the light blue line, interest rates peaking at about 5% and then falling fairly quickly, over the next couple of years to bottom out at around 3% or so. And then the UK, because inflation, is proving more sticky, it's coming down slower, then interest rates could continue rising for the rest of this year, maybe small steps, but sort of continue rising for another 6 to 12 months, and then start falling, but again at a much slower pace. And it was very interesting. One of those questions, one of the things which has been on my sort of radar is about the pace at which inflation will come down. And I think, the team, we were quick to pick up on inflation well before it started increasing. And therefore, it's one of the reasons why we adjusted the portfolios. So, for example, we went, quite significantly underweight bonds. We changed our duration. We were increasing our exposure to value sectors, which again, the other guys will talk about in a moment. So I think we are early to pick up on inflation, but I suppose really now, what's our view now? And I've just picked up on 3 areas which I think are the reasons why we think inflation, yes, it's going to come down short term, but why it might stay higher for longer. We believe it will, over that sort of longer term period. One is the demand for higher wages. And particularly the longer the inflation stays high, then the more that people say, well, actually, I now need to be compensated for that. They're going to start pushing for those higher pay rises. And also, we've seen that in various different sectors, for a number of months now. So that almost starts getting a bit embedded into people's psychology. They want that pay rise. Looking a little bit longer term, energy prices have fallen sharply. So over the last sort of 6 or 9 months, and this is perhaps where I will disagree with that poll we did. So oil's now back down to around sort of $75. Gas is well below sort of the pre-Ukraine conflict level. But my sort of hunch is I think these might start rising again towards the end of the year. And I think sort of tied in with that is what we could call the green revolution, or as the world economy moves more sort of sustainable. Again, I think that's going to be inflationary. And what's interesting is that not many people are talking about that. But when you look about electric cars, building out that infrastructure, digging stuff out of the ground so that we can go green, that's going to cost. And a lot of that cost is going to be borne by the consumer. So I think in that respect, we should expect higher inflation. And I think the last one I've got here is the end of globalization, and it happened pretty suddenly with the Ukraine conflict, SWIFT being used to take Russia out of the SWIFT settlement system, and effectively now we've got the West versus the rest. Whereas for the previous 30, 40 years, everyone was coming together. We had a lot of companies working together. But now, for example, Western companies, they're trying to get out of the East, bringing everything back, closer to home because of these growing risks. That is going to be inflationary. So I think those are the sort of things which are harder to put numbers on, but just to sort of give you an idea of how we're looking, further afield. So even though we can see those as risks, we're also saying, well, actually, how do we just navigate it? Yes, there'll be some sectors, even asset classes, which will be negatively impacted, but there could also be some companies and sectors or regions which will actually do better than others. And that's really what the team spends time doing, is saying, well, how do we navigate? How do we find those opportunities from those potential threats? And then just on to my last slide, just to sort of try and sum things up. And I've touched on some of these already. So the concerns, yes, how do central banks navigate, of trying to control inflation by putting up interest rates, but without tipping, the economies into sort of recession. And I think when one normally has inflation, and what central banks are normally trying to do when they're trying to put up interest rates is slow down demand. But I think it's fair to say, well, the demand's not the problem this time. So it's almost like quite a blunt tool, but it's like the wrong tool, but that's why they risk almost overkill and they tip us into recession. But at the moment, markets are not really sensing that. Whether you're looking at bond markets or equity markets, they're not sensing recession. So that thing actually could almost turn that concern into a positive. Rising mortgage costs, this is a big problem for a lot of people. And I talk about energy, maybe later this year, energy will start picking up again. And I've also spoken about, geopolitical tensions escalating. And I think the one thing which, I'd say is that war, whenever we've had war, it is always inflationary. So I think we can see whether it's the amount of money that, countries across NATO are spending. It's not productive, it's not growing the economy. And that's typically inflationary. So those are the sorts of concerns. And if I'd sort of pick out one other thing in terms of geopolitical risk, which concerns me, is, the West seem pretty adamant about sort of destroying Russia. There are no leaders in the West who are trying to find a solution. And so you kind of think, well, where does this develop? Where does this go? So I think that is a concern, but we're watching it closely. But let me just end on the positives, because there are a lot of positives. Inflation is starting to fall. As I say, slower in the UK, but much quicker in the US, and that's crucial because it drives confidence. And markets are all about confidence. You can say, well, actually, companies are growing earnings or interest rate inflation, but if you don't have confidence, then companies don't expand or investors don't go back into the market. So it's all about trying to rebuild confidence. So I think that's a great first step in trying to sort of get markets on more stable footing and potential recovery. This next point is not talked about at all, which I want to mention it here. There are many more savers than borrowers, and so if I look on the left-hand side, and this is why I've got them sort of one side and the other. What we've seen over the last 6 to 9 months is the mainstream media, banging on about sort of rising energy costs, rising mortgage costs, but they're not giving us the whole picture, because there are many more savers than borrowers. So while rising mortgage costs is hurting, a good chunk of the consumer and the population, there's probably 2/3 or 3/4 of consumers are actually saving. So they're getting higher interest, return on their savings accounts, which means that they can go and spend, or whether it's holidays. So we need to keep perspective on when we sort of see what we're seeing, the news stories saying, yes, inflation, what's the impact? Let's also look, there are some positives. And again, that's where the team try and navigate which sectors will actually be benefiting from rising inflation and rising interest rates. And lastly, compared with a year ago, bond markets are now much more attractive. A year ago, you could perhaps get, sort of 2% on your bond portfolios. Now we can get anything between 5 and 8% comfortably without taking significant risk. So we're not talking about junk bonds, we're sort of talking about corporate bonds or government bonds. So the bond market is now attractive, and equity valuations, attractive. But I'm sure the others will talk a little bit more about that. So I think it's just trying to weigh things up. Yes, we have those concerns, but let's also remember the positives, because there are still a lot. And I think in many ways, that's kind of why equity markets are holding up quite well. People often say, well, if we've got this potential recession, why aren't markets falling harder? Is because we need to look through some of the negative noise and focus on those positives. Thank you.
Thank you, Julian. Thank you very much indeed. I've had a couple of questions come in, so fear not if you've submitted questions. We'll keep them up and see if James and Will address them. If not, we'll look at them at the end. So, Will, over to you, sir.
Thank you, Cheeky. So if you just move forward a slide, that would be fabulous. Great, thank you. So good evening, everyone, and thank you for taking the time to be with us. And as Cheeky said, what I'm going to be doing is I'm going to be talking about what we've been doing on portfolios recently, really over the last 6 or so months, and then I'll hand over to James, who will give an insight into our outlook and what we've got planned for portfolios on the bespoke side. So here we are, really reiterating a lot of what Julian has said, but we came into 2023 with a number of concerns that we've all sort of spoken about already. Those big global macro issues out there, which we really saw as cloudy storms on the horizon. Inflation remained elevated, interest rates continuing to be hiked at a really rapid pace, unseen at that sort of pace before, and getting to a level that we hadn't seen in almost 12 years since before the great financial crisis. And of course, the geopolitics with the war in Ukraine, China relations with the West continued to be strained. And to a lot of Julian's points, the leading indicators that we had been looking at really pointed towards recession. So it wasn't a question of if, but really a question of when it would hit. It's still definitely out there that could be something that we need to anticipate over the next, up to 12 months. So we came into 2023 on the slightly cautious side with some cash on the sidelines within portfolios, but really to take advantage of anticipated volatility with all these issues in the backdrop. But what I will say is that we were within our suitability ranges for equities. We were a touch underweight fixed income, exactly as Julian was saying, and also slightly underweight in the alternatives. And that was really just the cash on the sidelines as we were awaiting the opportunities. So Cheeky, if you could move to the next slide, please. But as 2023 came through and we moved through, we certainly saw the opportunities come, and we were able to pick up some excellent holdings that fitted really well into the portfolio. And I can actually say, hot off the press today, we've actually just pushed a trade to purchase a high quality European-based pharmaceuticals company, really playing into that demographics theme, healthcare theme. And you'll see that there is a theme of dividends, which I'll talk to a little bit, but that's more sort of James's point. But this European pharmaceuticals company comes in with a dividend of 3.5%, which is certainly very attractive in portfolios today, given where interest rates are. And while we're on the demographics theme, this is probably more in our alternatives allocation in the property segment, is we bought Welltower, which is the senior homes company with properties in the North America, so USA and Canada, and actually also here in the UK. And again, so supporting our demographics theme of an aging population, very strong demand for these properties. And again, a strong dividend, very well covered, of 3.5% at the time of purchase. And since we bought that, that's performed well. And as Julian said, you know, with inflation out there, we're looking for the sorts of companies that we've spoken about in the past that can, you know, navigate through these situations. And we bought a very well-known consumer staple, so Coca-Cola, not too long ago. And, you know, that's a company that has had an excellent 12 to 18 months, being able to pass on price increases in the face of higher inflation, and actually able to increase revenues as well. So really solid company, one that we look at as being an all-weather company that should do well through rain and shine. And that has a yield of 3%, which is another attractive play for the overall portfolio. We also picked up T-Mobile. Now this is slightly different, so it doesn't have a yield as such, but that's more of a turnaround play following some news that wasn't digested very well by the market earlier on this year, following a takeover. And actually, we saw for the medium to longer term investor, the price levels that the market had taken that stock down to was extremely attractive. And so we made that purchase after the shares had come off for a turnaround play. And after, you know, a year or so of spending money on trying to bed down that takeover, they're now starting to see synergies and efficiencies come through. And that's definitely going to start playing into the earnings going forward. So a really good opportunity, a turnaround opportunity there. We also bought into a company called Agco. That was earlier on this year, and that's a play into the agriculture theme. And that's really as a result of the heightened demand for improved farming machinery technologies in light of certainly the war in Ukraine and the lack of fertilizer coming through in the world. So looking for those technologies to come through. And you know, that's definitely a long-term play that we see playing into that commodity field that should be, you know, positive for the next few years. But speaking about technology, you know, hardly a day goes by without artificial intelligence grabbing the headlines. And this comes after ChatGPT. That phenomenon was thrust into the world several months ago. And since then, we've certainly seen US markets really charging ahead, but led by a very narrow selection of technology companies. But we're really pleased that we managed to get exposure to not just that side of technology, artificial intelligence, but through into a more broad perspective of technology. And that was through the purchase of the Polar Capital Technology Trust, which we managed to pick up at a 20% discount to net asset value, it being a closed-ended investment trust listed on the stock exchange. And also within technology, we bought ServiceNow, which is an excellent digital workflow company, following a pullback in the shares, which was quite surprising. And we managed to get in a really good entry level for investors, which we think has got a really strong long-term story for the medium to long term. And switching across now from equities into the fixed income side. So as Julian was saying, interest rates have increased to current levels over the last 12 to 18 months. We've really seen the opportunity to take advantage of much improved bond pricing. With improved bond pricing means higher income rates. So we picked up some US Treasuries earlier on in the year, and also topped up UK gilts, as we're finally able to see those yields come through in a decent income following almost a decade of near zero interest rates. And then moving across into the alternatives, within that segment, we picked up two really exciting alternative funds that we believe will be really well positioned in portfolios. The first of which was Montlake Dunn. And that allocation provides investors an exposure to a global trend following fund, as the managers are looking for opportunities across a range of assets to take advantage of when prices go up and also when they go down. And there's a big focus also at the moment on commodities, which we, as I mentioned before, which we think will prove to be a really exciting area for investors over the next few years. The second fund was Cooper Creek. And that's a fund that specializes in long short equity, the US small and mid cap companies. And what the managers are doing there is they're looking for those value opportunities for companies whose shares have really been hit, but they've reached a level that offer really good value. But the key is there's a catalyst to affect that company turnaround, much like T-Mobile that we saw, but they're doing it in a really interesting sphere of the US small and mid cap space. So, and as I say, they're looking for those companies that have got turnaround opportunities to the upside, but because they can also go short, they're also able to take advantage of those companies that aren't so fortunate and whose shares will fall. They can take advantage of those. So overall, these two alternative funds, we think, fit in really well with our collection of alternative assets that individually are doing things very differently between one another, but collectively are really looking to provide much improved returns, dampen down the volatility as risks increase through markets, which inevitably we will see over the coming months and quarters. And as I've mentioned, with interest rates at these elevated levels, and obviously with bank interest rates slowly increasing, there's a bit of catch up that they all need to do. But it's just to reiterate that we are finding opportunities to bolster the portfolio income levels in all three asset classes. So not just the fixed income, but also through dividends in equities and in the alternatives. But as I say, James is going to touch on that, so I won't take any more of his thunder, and I'll pass across to James.
Thank you, Will. Clearly, my aspiration to get this all wrapped up in 30 minutes is you guys have got too much to say, so we'll carry on a few minutes and then break for questions after. Thank you. Cheers, Will. Over to you, James.
Yeah, thanks. Could you just knock on a few slides for me, please, Cheeky? I've got the enviable task of trying to cover this in 1 minute. So we'll quickly fly through these. I know Julian's touched on a lot of sort of the macro outlook, but obviously we're going to be sort of data driven, much like the central banks are at the moment in terms of where the direction of the markets are. Obviously, the market breadth has been very narrow, as Will said, and the magnificent seven, as you can see in that picture there, have really been doing a lot of the heavy lifting. It'll be interesting to see when the earnings sort of calls come for the next few quarters, how they stack up. Obviously, mortgages and interest rates are on everyone's minds at the moment. I'm sure they're on your minds as well. Obviously, we did a little bit of work to see what the impact could be coming up into the next sort of 18 months to 2 years on sort of renewals. And we're surprised to hear that a third of sort of properties actually have mortgage liabilities, and only a third of those again are going to be up for renewal in the next sort of few years. And as Julian said, there's more money in sort of fixed deposit accounts than there is in sort of mortgage liabilities at the moment. So I think, yes, it could be a problem, but I don't think it's going to be a massive issue, so to speak. the market has been obviously so resilient based on sort of a lot of the consumer COVID savings have been strong, and the labour market has been very strong. We still haven't managed to convince a lot of people that were still on the beaches post-COVID that are sort of semi-retired to come back to work. And in the US, I think people that have got more than 2 jobs, that figure's now sort of a 3-4 year high. So the labour market is still very tight, and I think central banks will still tighten into those conditions until they see sort of inflation get tempered. In terms of that, it's the scenario analysis. You've obviously heard the hard landing, no landing, soft landing. Obviously, no landing being that the inflation just keeps ticking up along with growth. Soft landing is the Goldilocks theory, which is what sort of the market's priced in at the moment, where central banks manage to bring sort of inflation down without having to cause a recession. And then the hard landing being that they sort of over tighten potentially so much that there is a pretty nasty recession. I think, as Julian said, we're sort of mind that inflation is going to be higher for longer, and central banks will probably do what's necessary to bring inflation down, and a period of economic weakness is probably unfortunately what is needed to sort of bring inflation back to normal levels. Let's just quickly reinstate our sort of investment themes in Bespoke. I know sort of what the activity we've been doing is reinstating this, but pick and shovel technology, obviously AI is a big part of that, but at the right price. Will stay. Obviously, it's been sort of heartbreaking seeing some of these sort of climb up that we did have that we don't have anymore, but we will get back in eventually. But we're not willing to pay the sort of 150 times PE that Nvidia is on at the moment. They will abate eventually. Emerging markets has been a core theme and an overweight for us for a while. We like that, and it sort of intrinsically goes with healthcare in terms of the demographics. Obviously, they've got a lot of emerging middle classes unbanked there. There's a big opportunity for sort of the growth that the West went through in the 60s and 70s that they will soon be going through. Obviously, healthcare, all the incredible breakthroughs in some medicines there are. We are going to be living much healthier lives for longer, and there are repercussions of that, and that's in terms of sort of the real estate and what happens. Obviously, we have Welltower as well, we said, for that, and some of the investment hurdles are geopolitics, not just Ukraine, Russia, but obviously China, Taiwan. They might get ideas of doing something similar. So I've seen a question in the chat already about sort of internal politics. I know we've had Trussonomics already, where our sort of political leaders try and wade in and make things worse. So that's always something that we've got to keep a watchful eye on. Runaway inflation, this one should more be sort of a central bank policy error. I think there could also be an eventuality where we see runaway deflation, sort of if they over tighten too much, and sort of tumbling earnings, which we'll be keeping a close eye on in the next few quarters in terms of how companies are holding up. If the consumer does start to weaken, are those price increases going to be sticky? Obviously, well, this is where we want sort of the quality companies, and that'll move us nicely onto sort of our trading horizon on Bespoke. And obviously we've been gardening and we'll continue to garden in sort of shorter bursts over the next few months, but sort of the larger areas and the deals that we're looking to do, obviously we've held the MSCI All World ETF, which has been our sort of exposure to international equities for the areas that we haven't managed to get back into, so the Nvidias, the ISRGs of the world. It's done us well, but it's not earning as much income as we'd like. So I think we're looking to do a bit of a switch where we're going to sell out of that and we're going to buy into some more direct US and European opportunities that actually pay us a yield of around 3 to 4%, because we know yield is so important. We want to pay a yield that would be similar to what you could achieve in sort of a savings and bank account. I know we've got some questions on sort of why would you invest when you can get cash or money markets, but I can cover that slightly later. I've got a few charts to go through if we've got time. But we still obviously want to get into the tech names eventually, so this is just sort of a stopgap to keep us in the markets, but also getting some income on our portfolio if we do see eventuality where the markets do tumble. And obviously we will rotate out of those and we'll go back into our core holdings of Google, Nvidia and ISRG, because they are perfectly matching our themes. But I will say anything that sort of we do add will also match our themes. We're not ripping up the fabric of what we're doing just for some tactical trades at this point. They're also going to be doing a little switch of the RWC Emerging Markets Funds. Great fund. It's done really well for us since we bought it, but it's more exposed to China than we possibly like, but it also doesn't pay us a yield. So we're swapping that out for another emerging markets fund that hopefully yields about 4% again. So our journey to 3.5 to 4% in terms of natural income and portfolios. Obviously, we often quote trailing yields, so previous 12 months. Obviously, the running yields will hopefully be closer to 3.5, 4%. And we also got a small underweight to US Treasuries at the moment. Obviously, timing that move to going to longer duration and locking that in is going to be interesting. So we don't think we've hit peak rates just yet. Certainly not in the UK for a while, but the US, I think there's a couple more rate rises to go. The reason we sort of held off is because the US seeming to be, as we've seen today, the CPI print seeming to be winning the inflation battle better than we are. And that will mean that they're likely to cut quicker than us, and that will likely mean that cable or the dollar or sterling is going to appreciate more. As we've seen, I think it's just ticked over 130 today, and I think that could be sort of on to 135. And obviously, that when you're buying US assets, not only particularly bonds, not only you can lose out on the price as the yield increases. Obviously, we don't really want to have that currency hit, so we're looking to either plug the gap with like a short-term cash deposit fund, or likely more likely sort of shorter dated UK gilts, so we don't have to take that sort of currency risk. And while the outlook seems to be sort of muddled and grey, the best thing to do when you don't have an absolute certainty on what to do is just move to your strategic weights. As Will has been saying, we've been gradually increasing that equity weighting, moving back to sort of the strategic weights where we'll be happy to be. Obviously, once we get there, we'd love to have a period where we just do nothing and let the portfolios work for us. But I have a feeling the markets will say otherwise. Actually, a quick 2 minutes, if I have some cheeky, probably kick me virtually, but just on some of the stocks that we've held for the long term that possibly haven't done so well. I know there might be some further questions on the likes of sort of Just Eat, Ocado, Babcock. Why are we continuing to hold these in a challenging environment? Well, there are sort of exposure to sort of when the rate cuts do get announced. I think we've seen today and in the past few weeks, I do have a lot of momentum. I think if I showed you the top 5 performing stocks we had today, I think those 3 would be in those top 5. Ocado obviously had good news flow on Amazon, hopefully, well, potentially taking them over, and seemingly they've managed to maintain that sort of level. And we've had a similar story with Activision Blizzard. They had some social challenges, shall I say, a few years ago. We decided to hold on. I think we topped up, and then Microsoft came in and swooped in and bought them, and then there's been some anti-compete issues. But I think today sort of the news has come out that the FTC at least have accepted the deal, and it's popped up to about $90 a share, which I think is $5 under where the actual bid is. I think it's just waiting for the UK authorities to sort of give that the green light in terms of anti-compete. But it just goes to show that if you're patient, you can be rewarded, and we don't want to be chucking the proverbial baby out the bathwater just yet, and we'll be managing our exits effectively. I do have a couple of slides on cash and why would you invest in cash. Cheeky, if you think we've got time. Failing that, I know we've got an article coming out that's sort of written by me and sort of Cheeky's publishing that we can go into a bit more detail, but I can cover it off here if you think it'd be worthwhile.
Well, you know what, it's a perfect conduit into our questions and answer session. One of the questions we can get a lot of from meetings with financial advisors and from clients is, why should I remain invested when interest rate or fixed term saving rates are 4, 5, 6%? So perfectly timed, James. Well done.
Cool, thank you. So yeah, we've got a couple of slides we want to knock onto those, but it's sort of two-pronged. I think there's the opportunity cost of going into cash deposits, which can get you 4 or 5% in the bank, and obviously everyone's encouraged to do that on your own finances. Is that something we're doing here? Also, we're looking into the more vanilla options. There are other options like money markets, which sort of use more intricate plumbing, which, yes, they are, because of their very shorter duration, less risky, but inherently, when there are times of sort of liquidity crunches like we saw in 2007-8, like we saw in sort of March 2020 when the bond market broke, you're not always going to get your money back. So it's something, I know there's a record numbers of money that's piled into these funds, but they're not risk free. And in terms of sort of the opportunity cost of, okay, let's take a lot less risk and just sort of try and sit this out. Well, history would show that you're better off sort of staying invested and keeping investment professionals like us. We are actively managing your risk profile up and down. And obviously we've been on the slightly more cautious side, slowly putting the accelerator on into this rally. But it just goes to show that if you miss some of the best days just by sitting on the side, yes, you might have missed some of the falls, but over time it can really be damaging to sort of your capital returns over the long term. And obviously we know that you guys are all long-term investors, and obviously that cluster chart on the right shows that some of the best days and the worst days are clustered quite closely together, so it can become very difficult to sort of time that.
James, sorry to interrupt. Just for the novices on the call like myself, the chart on the left, what does that actually show? The graph.
So it shows obviously there's different lines there that show if you miss the 10 best days, if you miss the 30 best days in terms of that year's of performance. So if you're sitting in cash, you are not going to be participating in those rallies. So the more rallies obviously that you miss, the longer and the bigger effect that has on your capital returns in the long term. And then that cluster on the right basically goes to show that a lot of the falls are then subsequently quite quickly followed by these best days in the rallies, like you sort of in March 2020. Some of the best days were a week, if not sort of days after that. So timing that switch from cash into that is not something that even some of the best investors in the world can't do. So we obviously actively encourage, and history would dictate that the most sensible thing to do is sort of leave your money invested and let us really manage that risk actively for you.
Perfect, thank you. Right, I've got a couple of questions. I'm very conscious of time. We've overrun a little bit. One of the questions that came in earlier is, and Julian, I think it's probably best for you actually, because I think you addressed it a little bit, but just for clarification, is war still affecting markets?
Okay, good question. No, not anymore. I think if you look back, when we had the initial sort of the conflict in Ukraine, different markets reacted differently. So obviously, probably the most obvious ones, which we all saw, was things like oil and gas. So obviously, those rose very quickly, very sharply. Interesting, actually, if I just take crude oil, that was trading around $90, pre the conflict. It rose up to around sort of 130, and it's now back down around 75. So oil was already rising before the conflict, rose further, and then it sort of fell back over around sort of 6 months. Gas was perhaps the one which is even more volatile. That rose several fold. But again, it sort of peaked about sort of 6 to 8 months later, sort of roughly last October, November. Other areas to look at, because obviously those are the ones which probably tend to grab the headlines. Other markets you could look at is things like wheat. So obviously Ukraine being a massive exporter of wheat. Again, that's fallen again lower than the pre sort of conflict levels. That crisis period was actually a little bit shorter. Other sort of potential safe havens you might see is things like the dollar. So again, that only rose literally for a couple of weeks before that started falling. The one which I've been looking at just recently is which is staying more elevated. So whereas most are lower than pre-conflict, but the one which is more elevated is gold. So that rose initially, and then it had a fall back quite quickly. But that's actually one of the very few which is now higher than it was previously. So that's something which we keep an eye on, because it shows that most markets have become quite relaxed over the last 6 months to say, we can ignore it. Yes, it will drag on, but let's not get too worried about it. But there are potentially 1 or 2 markets which are still perhaps flashing more amber than they were previously. And I think this is when markets, just to quickly sort of finish off on this, is what we, when we, going back to my comment about inflation, when we picked up on inflation in 18 months, 2 years ago, we're trying to find things which we think could be an issue, but the market's ignoring. And that's when we picked up on inflation. We do our own research. We're trying to find, are we onto something here? And we felt yes. We position the portfolio to sort of protect or take advantage of that return of inflation. And again, with conflict, it's much harder, but because we feel there is some complacency coming back into markets, because everyone's thinking, let's kind of ignore it, or it's just going to somehow, fade away, but we think, well, actually could get worse, then this is why we're trying to spend a bit more time just focused on that and to see how do we navigate that.
Perfect, thank you very much. Another one that's come in online while we've been here is, I want to see who will take this one. Chancellor and pension funds not mentioned as a risk. That's probably for you again, Jules, isn't it? Because in your risk and concerns.
A quick, the Chancellor. Yeah, I suppose we can't make personal comments. I probably want to pass on that, but I'd say yes, they probably are risks, but I think there are probably bigger risks out there. The Chancellor, it looks more stable than we had sort of previously, but I think they're probably playing sort of tough. But I think let's remember that in the UK and the US, we've got elections coming up in the next 18 months. So it's probably playing tough now to try and reassure the markets that they're on top of things. Although interestingly, when you look at bond yields, bond markets, when we had that sort of little panic when Liz Truss was in power, and almost bond markets told the government you can't do that. We actually look at bond markets now, and they're actually at worse levels, as in yields are higher than back then. So bond markets, because it's been done more gradually, bond markets are saying, well, we don't have confidence in the Chancellor. But no doubt, ahead of the election, they'll start doing things to sort of try and win votes again.
Perfect, thank you. And this one's open to the floor. How will 12 plus years of quantitative easing be paid for without keeping interest rates higher than expected?
Yeah, I can speak to that. So yeah, 12 years after the great financial crisis, and our economies became addicted to quantitative easing. And I think the short answer to that is it's hard work. And really, we've seen that come out through inflation. And we spoke about this actually before we'd even fully come out of the pandemic, in that we were expecting interest rates to come up, and also to the point on the fiscal side, tax increases. It has to be paid for somehow, and it's tough. It really is, and I think that it's going to be harder than we think. Ultimately, we've spoken about it over the last 45 minutes or so, and that is, the concern that we've taken the punch bowl away. We're sort of the medication to try and solve this is tough, and we don't want to see ourselves go back into a nasty recession where we're going to have to start it all over again. So that's where it was interesting news to see in the US how inflation is slowly but surely coming in as better than expected. And now the decision will be, what does the Fed do? If they got another couple of rate increases. I think where we've come from over the last 12 to 18 months is incredible, and nothing has seriously broken yet. But of course, in March, we had the regional banks in the US, which seems to be largely contained. But these are the sorts of things that we're looking out for in terms of making sure that we can invest very cautiously and carefully, and ensuring that things don't break. And if we start to see signs that things are going to break, we hope that that's not the price that we pay for having 12 years of quantitative easing.
Super, thank you, Will. Ladies and gents, we've overran my aspirations to get this done in half an hour. We're a little bit keen, but hopefully shorter, sharper, and to the point. As always, if you have any further questions regarding anything we've talked about, please do contact your financial advisor, or indeed give us a member of the team here a buzz. A date for your diary. The next one of this is scheduled in for Wednesday, the 18th of October. We're going to hold these on a much more regular format now, probably 3 or 4 times a year, depending on frequency and demand for these. So 18th of October, I'll send out invites in due course. But all it leaves me to do is say thank you for giving up your time in the evening, and thank you to the panelists here for taking part and giving up your evening. Thank you, gentlemen, and thank you, ladies and gents. See you soon. Bye-bye now.